Good afternoon, everyone, or good morning, depending on where you're watching from. Welcome to Questrade's webinar series. Thank you so much for joining us. My name is John, and I'm your host from the Questrade education team. Joining me shortly is our very special guest and presenter. And here's our quick disclaimer. So please remember that the information conveyed in this webinar is for informational, educational purposes only and does not constitute advice or recommendations by Questrade. Don't worry, not going to read the whole thing here. Moving on. Now, without further ado, I'd like to introduce our guest speaker today. Hale Yang is a director at BlackRock, where he leads product consulting, content, and more for the Canadian iShares business. He's very passionate about investor education and is responsible for providing ETF subject matter expertise across the entire Canadian iShares ETF business. Hale joins us today from Toronto on this beautiful spring day where it's feeling more like April than February. Thank you again, Hale, for being here to present, and take it away.
Thanks very much, John, and thank you to Questrade for having us on today. Over the next hour, we'd like to kind of unpack a little bit of ETF 101, ETFs Diversified Investing Made Easy. If we just advance to the next slide. Oh, actually, before I do that, I need to actually keep this up for a little bit just as a introductory disclaimer on our end as well. So we've got the Questrade and iShares disclaimers now out of the way. I think we can probably move on. Here's the agenda that we'd like to tackle today. We'll start with the very basics. What is an exchange-traded fund? Move on to the benefits that lots and lots of investors now enjoy through ETFs. And then finally move to a section where we kind of hopefully educate a little bit on how to evaluate ETFs that are right for you. I think the way John and I kind of hashed out the order is I'll stop in between each section, each of these colored sections. We can do a sort of a light Q&A, if you will, if there are any questions. But as John alluded to, we'll save the bulk of questions for the end of the presentation. So if we advance a slide, and maybe one again, start with a quick definition. What is an exchange-traded fund? An ETF is basically an investment product type that combines the benefits of two well-known investments, right? It takes the concept of a mutual fund, which I think most people are familiar with, a professionally managed, diversified portfolio offered across a range of strategies, and couples that with the liquidity of a stock, right? A mutual fund is typically only available to be purchased and sold once a day. An ETF takes that mutual fund and basically lists it on a stock exchange so that you can trade it real time and real prices at any point during the trading day, which in Canada, as you know, is between 9:30 and 4 p.m. Eastern time. A couple interesting points about ETFs. This is actually a Canadian innovation, right? The first ETF in the world was listed on the TSX back in the 90s. It still exists today. It is a ticker that trades on TSX and tracks an index called the S&P TSX 60 index. And we're going to get into indexes a little later. And also the first bond ETF in the world, so an ETF that held bonds, was also launched right here in Canada. So another Canadian innovation in the early 2000s. And that ticker too actually remains the largest bond ETF in Canada. And it tracks an index called the FTSE Universe Bond Index. Again, we're going to get into indexes and the definitions of those in a bit. So a Canadian innovation is grown from, the handful of ETFs that I just mentioned to over 1,000 listings in Canada and over 400 billion of AUM. And globally, thousands and thousands of listings of ETFs across exchanges all over the world, and literally trillions of dollars of assets have flowed into ETFs. And investors of all sizes have really embraced this investment product type, from large institutions to financial advisors to increasingly end investors like yourselves, who've kind of reaped the rewards and the benefits of the structure, which we'll touch on throughout this presentation. So as I kind of have already described, this idea of indexes, right? So ETFs today actually encompass lots of strategies, from index tracking to active. But I really wanted to focus today's conversation on index tracking ETFs. And the reason is because this is really where ETFs grew up. As I just mentioned, the first two ETFs, the first equity and the first bond ETF in the world, were index tracking by nature. And so maybe a good place to start as it relates to that is what is an ETF? So actually, John, if we can just actually flip to the next slide. I'm going to skip one here, but then we'll come back. Before I get into like stock and bond market indexes, I thought what might be useful is just to describe like indexation generally, right? So inflation is something that we all hear about and read about in the news every day. Grocery prices are going up, gas prices are going up, energy, rent, mortgage costs, etc. And so how do you measure inflation? Well, you measure it through something called the Consumer Price Index, right? So an index, this index is constructed using a basket of goods that you as a Canadian might consume and weighted in a way that sort of reflects sort of a purchase basket of a regular Canadian, right? Of groceries, of gas, of energy, of rent, mortgage costs, etc. And it is the performance of that index, right? The increase in the value or the cost to purchase that is basically how we measure inflation. So it is a collection or a basket of assets. I'll give you another example that is probably pretty near and dear to many Canadians. House prices, right? We often talk about house prices in Canada. We've followed it for many years. For the first few years, it was really about sort of the awe of like, how can this market rally so hard? And now increasingly more about sort of affordability issues. But in any event, how do you measure these house prices? It's through an index as well, right? You can imagine that there's an index that captures all the houses in Canada, sort of theoretically, and sort of tracks the value of those over time. And that's how we basically sort of measure how much it costs to buy a house. And what I like about this example is you can also then subdivide that index, right? So then you can say, well, I want to know how houses in Toronto are priced versus Vancouver and what the rate of change is there. I also want to know within Toronto, semi-detached versus detached versus a condo. We can actually sort of index these things right down to like almost the postal code, right? And so this is just another example of like how indexation is used to capture a basket of assets and then sort of measure that value over time. And so those kind of examples kind of convey what financial market indexes do, right? So with stocks and bonds, basically the same thing has occurred, right? You can take the entire universe of stocks in the world. There's an index for that, MSCI All Country World Index. And then you can measure the performance of that basket of assets, that basket of securities over time. Moreover, you can then subdivide it in the way that sort of my house index example worked, right? You can take slivers and slices and nooks and crannies of that index. You can do countries, you can do regions, you can do sectors. Any sort of variant or sub-industry or subsector or slice that you'd like to see of the market, you can basically index and track the performance of. And this is basically what's happened to the entire financial market. The entire investable financial market has been indexed. The important distinction between financial market indexes and sort of the example I used before about the housing market index is that funds can then seek to replicate the performance of that index, right? You can't really seek to replicate the performance of the Canadian house price index in sort of exact replication, because you'd then have to basically go out and buy every house in Canada, right? So you can't like practically achieve that. Contrast that with sort of financial market indexes of stocks and bonds, and actually a portfolio manager and a product and an exchange traded fund can literally buy all the components of the index and seek to replicate that performance, right? And so what is an index really? It's basically like a paper portfolio. It's a recipe, as this slide would suggest. It's a set of rules that defines what's in and what's out, and how much of what's in do we hold. That then gets measured to both reflect the value of some asset class or some subsegment of that asset class, but also is investable in a financial market context. And a lot of exchange-traded funds, certainly in the early days and still today, the vast majority of assets sit in ETFs that track an index. And so, and sorry, John, I'll back you up one slide here. If we just go to the previous slide, there's lots of indexes that you probably are very familiar with, things like the S&P 500, a measure of 500 large stocks in the US, the S&P TSX Cap Composite, which is a generally widely quoted gauge of the Canadian stock market, capturing most of the Canadian stocks listed on exchange. And then there's lots of indexes that you might not know. MSCI EFA, that measures a bunch of developed market stocks. FTSE Canada Universe Bond Index, this measures all the Canadian investment grade bonds in Canada. And as I alluded to, all of these have been further refined and sliced and narrowed down into lots of different versions of indexes that an investor can own through an ETF that seeks to track that exposure. Okay, so I'm going to move forward maybe past the next slide. I'll pause here for just a second because we're moving on to a new color. John, if you wanted to ask any questions that might have come through right now, you can. If not, we can just keep going.
Sure thing. And thank you so much, Hale, for that really great benefit kind of intro on indexes and some of the benefits of one of the things they can track. One of the questions that has come up quite a bit that I used to get all the time when I worked in sales and still get to this day in marketing from friends and family is what's the difference between an index fund and an ETF? I know these terms are used interchangeably a lot of the time by advisors and the media. Can you kind of elaborate a little bit more on maybe the broad differences between an index fund and an ETF?
Yeah, when I hear the term index fund, I generally think of that to mean an index mutual fund. And so there are mutual funds that kind of trade once a day that would also seek to replicate indexes, versus an index tracking exchange traded fund would be, a fund that seeks to track an index that trades on an exchange intraday. I think both would seek to provide exposure to the given index. It's just the wrapper with which you buy it. Sometimes they're kind of used a bit interchangeably, if you will.
Definitely. And I'm sure we can get into some of the differences between mutual funds and ETFs a little bit later on in the slide in the presentation too. So really appreciate that insight there. I think maybe one that I can pick off here from the audience that's really quick and easy. What does it mean to maybe track an index? And by that, when we're talking about a fund that tracks, let's say, the S&P 500 as an example, the tracking would involve basically holding the same assets as the S&P 500 in the same percentages. So the largest company in the world, the largest percentage would be the largest percentage of the index, whereas company number 499, company number 500 would make up a very small percentage of your fund. So that way, basically, the fund replicates what the index does and tries to track the performance as close as they can. Maybe one more for you, Hale, before we move on to the next color. And that's after an index selects a company to include, maybe going back to my previous example. Let's say I was a shareholder in company 505. So just didn't make it into the S&P 500, but had a really great earnings season. And then now my company's grown. And now it's part of those indexes. Can you elaborate on how much of each stock that index might hold and maybe how me as an investor, I might be able to go into these funds and see, okay, let's see this S&P 500 index. How much of XYZ stock is in here?
Yeah, so I think you can think of indexes as sort of like paper portfolios that have their own rules for inclusion and exclusion, but also periodically rebalance, right? So for the S&P 500, for example, every quarter, every 3 months, it will rebalance and basically refresh its holdings to reflect, the 500 stocks that it's supposed to reflect. So in the example that you just described, like say on one of these quarterly rebalances, it then recognizes that 505 from 3 months ago has grown to be 490 or whatever. It might then sort of decide to, the rules might dictate that it then adds that company into the index and kicks another one out. The S&P 500 is a market cap weighted index. What that means is what you just described, right? Constituents are weighted by their size. And so the largest company in the world gets the biggest weight, smallest company in the 500 gets the smallest weight, and it's kind of all proportionate. And so that'll dictate sort of size of holding, but not every index is market cap weighted. And as we'll get into, when you read the index rules of all the different variations of indexes that have been created, there's lots of non-market cap weighted strategies out there too, right? So if you have a dividend strategy, for example, that seeks high dividend companies, it might be such that, not necessarily, it depends on what the recipe says, but it might be such that that strategy decides to, the way that it constructs its index, its basket, is it sort of more heavily weights the higher yielding companies, for example, right? It might achieve this through a yield weighting strategy. And so there's lots of different versions of how you might construct it. You can think of index rules as a recipe, sure, but also as almost like the automation of an investment process, right? So whatever your investment process might be, if you can set that out in a set of rules, then an index can basically automate that set of rules.
That's perfect. That really helps provide some clarity on that. So thank you so much, Hale. I think we'll cap it there for questions since we've still got a little bit of presentation to go, and I'm sure we're going to have a lot of Q&A after. So let's move over to maybe what are the potential benefits of these ETFs, and I'll pass it back to you.
Sure. So thanks. If we move just to the next slide, then there's lots and lots of benefits of ETFs that we could select from. Here's three that we just decided kind of makes sense for this session. Diversification is one, right? The title of this session is Diversified Investing Made Easy. ETFs and index tracking ETFs are by definition almost diversified, right? Like indexes themselves are a collection of securities. And so you can get immediate diversification in one trade. In fact, some of the broader indexes, like the global ones or the regional ones, even the country ones that seek to track the complete list of securities in that market, can hold hundreds or even thousands of names and securities within the portfolio. And we'll get into the importance of this in just a moment. Transparency is another one, and this kind of like in the past, it may have been that you sort of handed your money over to somebody to invest in a bunch of things. They then handed their money over to sort of products and investment funds and structures that were sort of a black box in the way that things were selected and weighted. And so you kind of, each step along the way, you sort of lost a bit of transparency in terms of what you were getting. I think what ETFs and index tracking ETFs have done is really kind of empowered the end investor to take a little bit more control of their own destiny and their own portfolio, because they know exactly what is going inside the recipe and in the container that they buy, right? The indexes themselves are by definition usually like transparent. The rules are disclosed publicly, so you kind of know what you're going to get. And the funds that track these indexes kind of faithfully hold those securities, so you kind of can very modularly build a portfolio. And then the final thing is low cost. ETFs have become, and particularly index tracking ETFs, have become synonymous with low cost. We'll get into the benefits of this as well. In a way, I feel like I don't need to necessarily explain it to this audience. I've seen the Questrade ads that do a nice job of explaining why this is so important, but we'll touch on it as well. So if we just dive into each of these pillars in a little more detail, the first one is diversification. And yeah, so you can move to the next slide. And we thought we'd illustrate this point through a bit of a poll. And so here's the question, right? So the US stock market has returned. Oops, sorry, my screen just locked on me. Just get back in here. The US stock market has returned approximately 13% per year over the past 5 years, but what percentage of the stocks in the US are actually down over that time period? And so you've got a number of choices. The answer is actually over 40%. It's close to 41%. So just to fully disclose what we've done there, we took what's called the US total stock market index. This is an index of like thousands of names, call it 3,000 names. And a lot of them are small, right? They're tiny. But what we're measuring here is kind of like, if you had just like a dartboard of all these names, 3,000 names, and you were just picking stocks, right? What is the probability that you'd pick a stock that was down? It's actually 41%, right? Because a lot of these smaller companies that make up the tail of the index were actually, didn't do that well. Whereas had you bought an ETF that tracked the US total stock market, the S&P total stock market index, which are available in market, you would have earned 13% a year, right? So anyway, an illustration of why diversification is important. It protects you from some of that single stock risk. If we just move to the next slide, this is the same thing said in the Canadian lens. We took the Canadian market, the S&P TSX Composite. It's like 230-ish stocks, something like that. Same idea. Canadian stocks are up about 10% a year over the last 5 years. But if you look at the number of stocks that were actually down over that time period, 18%. Call it 1 in 5, right? So again, if you were throwing darts at a dartboard, you had a 1 in 5 chance of actually, losing money when the market was up 10% a year. Meanwhile, on the right here, you see that had you bought a diversified investment like an ETF or mutual fund, your risk of loss was dramatically reduced down to less than 2%. So just an illustration of why kind of diversification is an important element of constructing a portfolio. And in fact, the saying goes, right, diversification is the only free lunch in investing, so ETFs can make that easy. Second point, and we can actually probably skip this slide, actually, John. Second point was really, and I've harped on this a bit already, but I'll just sort of elaborate some more, the transparency bit, right? I do think that index tracking ETFs in particular have gained lots of popularity with end investors because they allow you to sort of more fully control what is inside the portfolio and put the pieces together in a far more deliberate way than maybe you could in the past when you were sort of having to outsource all the decisions around what goes inside the portfolio. Indexes themselves are very deliberate and transparent about what they hold, so you always know what's inside your portfolio. And so, typically the way we see investors approach this is they start with very broad exposures in equity and fixed income, representing, broad global stock market benchmarks and broad bond benchmarks. They use that as sort of a base. And then from there, they seek out strategies that express their own customized personal views, right? And like I said before, if you have a strategy in mind, there's probably an index that reflects that in a diversified way. And then there's probably an ETF that can deliver that in a low cost way. And so this makes it very easy to construct a customized portfolio. So if you want dividend paying companies in Canada, probably an index and ETF for that. Tech companies in the US, same thing, right? Consumer discretionary companies in Europe, small cap companies in emerging markets. You want semiconductors, you want a theme like companies that might benefit from the low carbon transition. You want companies screened for quality metrics like strong balance sheets and sustained earnings, or even companies that appear to be priced inexpensively relative to their fundamentals. There are indexes that basically have captured these rules, screened the market, and delivered you an index, and then there's probably an ETF that tracks it at low cost. And so it allows you to then sort of build out your portfolio in a very customized way. Third benefit, if we move to the next slide, low cost. Like I said, I'm very familiar with the Questrade ads, so I think this is kind of in your wheelhouse here. I think a question that sometimes comes up is, so ETFs are generally, as this bar graph would show, generally priced lower than alternatives out there. And the weird thing about, I don't know if it's a weird or funny thing, but unlike in other parts of your life where when you buy more food at a restaurant, for example, and you pay more, you kind of expect more, right? Either more volume or more flavor or something. Investing doesn't quite work that way, really, right? With investing, the funny or weird or unintuitive thing is that every 0.01% of fee extra that you pay actually comes straight out of your return, right? So there's actually like this inverse relationship, all else equal, that every time you spend an extra basis point, that all else equal exactly equates into one less basis point of return that you earned. And so keeping your costs low and being mindful of your fee budget is an important consideration when investing. And I think Questrade does a really nice job of showcasing that in their ads. One question that I sometimes get is like, well, how do ETFs keep the costs so low? And so I think the analogy here is one of one to the travel industry. Decades ago in the 80s, if you wanted to book a vacation, you would call a travel agent. That travel agent would sort of compile all the right combinations of hotels and flights and cars and whatever, and present to you a number of different options. You'd iterate on that, probably would take a couple weeks, maybe a few weeks. They'd kind of keep on coming back with all these manually compiled combinations. I call them baskets for now. Baskets of options that they will deliver to you. For their time and service, my understanding is they would charge you a commission of about 8%. Fast forward to today, and you just go to a travel website, you select your own kind of criteria, you're probably done in 5 minutes, and there's a nominal fee applied, right? What's happened is sort of the availability of data, modernization of computing and analytical technology has basically enabled the automation of all the things that used to be done manually, right? In such a way that actually all the different combinations of the things that you were looking for, that rule set that you might have defined, that recipe for your vacation, is automated and pumped out at you on a website and offered at whatever, $25 service fee or whatever it is, from an 8% commission. You can argue the same thing has happened in the investment industry through indexation, right? All of this data around all the securities that exist in the world used to require sort of manual poring over to sort of arrive at different portfolios of different subsegments of the market, of different ideas and active strategies and themes and whatever. And now that's all basically done sort of with the click of a mouse, right? It's been completely automated through indexation. And that scale is then delivered to investors through low-cost products like ETFs. And this is kind of what we mean when we say index ETFs have democratized investing. It's sort of allowed sort of access to lots of investing strategies at scale. And so if we move to the next slide, I think probably Questrade has a version of this. Why do fees matter? Well, because over time, they'll eat into your investment returns. So the lower you keep your fees, the more you get to keep in your account. And over time, it does add up. So this is just a hypothetical example. We used some kind of rough estimates of balanced fund expense ratios. And on a $10,000 investment, you can see that actually you could save more than the principal, $14,000 over time, had you selected the lower cost option. Okay, so that's the conclusion of the blue section. Maybe we'll just keep this slide up, John, while so folks can read it.
Definitely.
And if there's any questions, we can tackle them before we move to the next section.
Sounds great. And thank you so much, Hale. We really appreciate that graphic. I think you're absolutely right. We offer something very similar on our retirement calculator page on the Questrade website, where you can kind of plug in your initial deposit amount, how much you want to add per year, how long you're investing for, and then we'll compare the fees of ETFs versus mutual funds. And it's a very easy picture to paint, to be honest, that even just over 30 years, over 10 grand, you can save a huge amount of money just because you're paying less for someone to manage your funds. And I personally love that travel agent analogy. I think that worked quite well. Just had maybe going back to one of the questions that came up from the audience and that you touched on as well, and that's how ETFs are offered so inexpensively. So compared to mutual funds, I know you mentioned, in the past, there was a lot of research, a lot of manual work that people had to do. Maybe even today, why do we still see that huge difference in management fees? Where in Canada, we're seeing an average of almost 2% for mutual funds, whereas ETFs are looking at 0.2% or even less.
Yeah, I mean, I think it really does come down to the scale and automation. So if I use kind of maybe a more active analogy, if you wanted to previously purchase a strategy that, say, looks for companies that exhibit quality characteristics as defined by low debt to equity ratios, high return on equity, and low earnings variability, right? As your metrics of like, I want to screen every company in the world for those three metrics. I then want to organize them in a certain way and put them in a portfolio at certain weights. That would have actually required a lot of spreadsheeting and such. Whereas nowadays an index can do that sort of like at the click of a mouse, right? Like it just consumes all the data, rank orders everything, finds, the standard deviation of how far away these ROE and debt to equity metrics are versus the industry, compiles it in exactly the rule set that you've defined in advance through the index recipe, and then shows you your portfolio. And then an ETF that seeks to track that can do so at scale as well, because you can have sort of one team just tracking lots and lots and lots of indexes, because it's actually not, it's not like you need a specialized team looking for quality companies, for example, whereas maybe you had that in the past. Actually, all of that is just automated now. And so the scale that delivers is basically passed on to the investor through lower fees.
Absolutely. And I think we can echo that at Questrade a little bit, kind of passing on those efficiencies and passing on those fees. ETFs are basically the same thing. Technology has allowed us to scale things, leverage things to, just not charge people as much as we used to in the past for the same thing, more or less. It's kind of like your restaurant analogy. You'd expect if you're paying more for your investment to get more, but it's kind of the opposite, where those, fees do have a negative correlation to your returns over the long term. Maybe just had one more question here before we move on to how to evaluate an ETF and how maybe an investor would pick which ETF would work best for them. And this question came up right at the beginning, and I see a few upvotes on it as well from the audience, and that's the difference between an accumulating and a distributing ETF. So, in other words, an accumulating ETF would be one that the dividends are reinvested back into the fund, whereas a distributing one, they're paid out to the investor. Can you elaborate a little bit more on that for maybe some of our newer investors?
Yeah. So maybe where I'll start is the index variant that most index tracking ETFs track are total return indexes. So you participate in both the capital, appreciation or depreciation, plus the income, dividends, et cetera, that the portfolio generates. More commonly, I would say, the income is distributed as cash to investors in an ETF. Certainly in Canada, that's the most common we see. And then the cash that you get in your account is taxed in the same way that it would be had you owned the securities directly. So a Canadian dividend paying portfolio will distribute cash. It will be reflected as Canadian dividends to a Canadian investor, and they'll claim all the relevant tax credits, etc. Interest income will come through as interest income and taxed at the interest income rate, and foreign income will come in as foreign income. That's generally how it works. And so you receive the cash in your account, and in Canada, you pay tax on it. Accumulating share classes would sort of, or funds, or series of funds, would generally reinvest that into the fund so that none of the cash is actually paid to you as the investor. But in Canada, there's not a tax difference that would arise as a result of that. The fund itself is required in Canada to distribute all of its taxable income to investors. And so even in an accumulating structure in Canada, while you wouldn't receive the cash, you would receive the tax slip at the end of the year that says, hey, you received this much in dividends or income or foreign income from this fund. You didn't see the cash because they immediately reinvested it into new units of the fund for you, but you still owe you still owe tax on this much income. And so then I suppose you would liquidate part of the fund to sort of fund the tax liability. That's basically the difference. I think in Canada it is mostly it's mostly like a feature of convenience. Say you know that you don't need the cash, you want it always invested in the fund, and you don't want to sort of manually reinvest the cash. I could see that an accumulating share class would be beneficial in that case. Our experience has been generally that people like to see the cash.
Yeah, I think that's kind of what I've seen too, and appreciate the clarity on the difference there. Yeah, sometimes these are also called phantom dividends from those accumulating ones where, the CRA still wants their tax at the end of the year, but if you're investing in let's say a non-registered account where the tax is owable, you will still get that tax slip at the end of the year. And that actually touches on the last point of this ETF FAQ that maybe I'll mention before we move on is, can you hold ETFs in retirement accounts? And the answer is absolutely yes. Whether you're with Questrade or elsewhere, you can hold ETFs in RRSPs, TFSAs, FHSAs, RESPs for your kids. Basically, any registered account is eligible to hold ETFs. And yeah, maybe for many of the reasons we've talked about, you guys can consider those. So we'll pass back over to Hale for the next section here, how to evaluate an ETF before we wrap up with the Q&A at the very end. Thanks again.
Okay, final section, our yellow section. I don't think this should take too long. How to evaluate an ETF, find the right one for you. Three-step process, if I had to boil it down. I think you start with what is your own investment objective. What goals are you seeking to accomplish? But perhaps most importantly, what's your risk tolerance? How much risk are you willing to bear? And this is often driven by like, what is your time horizon, right? Like if you are, and you've probably all heard this, right? Like if you're young, you have a stable income, you're 40 years away from retirement or a planned retirement, you don't need to touch this money for a long time, then you probably have a higher risk tolerance, right? You can withstand the highs and lows of market volatility to ultimately achieve what would be a higher expected return. But if you're actually, on the brink of retirement, then the opposite would be true, right? Like you really can't withstand a big negative year because that would wipe out your savings or any of your investments, and so you really kind of have a lower risk tolerance. From there, I think what happens is you express your investment objective and your risk tolerance through what is called an asset allocation, and we'll get into that. And then from there, you can kind of pick what ETFs would fulfill your asset allocation and build yourself a fairly diversified, robust portfolio at low cost. So if we move to the next slide, this is a bit about the investment objective, right? On the left here, what we've got is kind of like cash, savings account stuff. This is like this wouldn't be considered investing. This would be kind of saving mostly. But as you move between asset classes, so to bonds and then to stocks from there, you're basically stepping up each time in risk. Oops, sorry, I didn't move my mouse enough, so my screen locked. Sorry, one sec. So the illustration on the right, I think, does a good job of describing like what does this actually mean. If you stay in cash, things are really stable, right? Your bank account balance doesn't move that much. But what you earn, and this is data over kind of over 15 years, what you earn won't actually even keep up with inflation, right? And so that's why everyone's encouraged to invest. So as you move out of cash and into bonds, what you find is that you will earn more and probably enough to sort of outpace inflation, but you take on a little more risk relative to cash, right? Like you might post a negative return about 1.5, 1.7 out of every 10 years. So suddenly your capital kind of is a little more volatile. And then from there, if you step it up to stocks, again, your return potential really increases. Historically, again, over the last 15 plus years, you would have earned almost 7.5% a year. But so does your risk, right? You could have had a negative experience close to 3 out of 10 years. And the other thing that doesn't really show up on here is like also like the volatility, sort of like the peaks of your peaks and the depths of your valleys as you move from bonds to stocks also widens, right? So like the negative years can be quite negative in stocks. But over time, if you have the time horizon, the risk tolerance to endure that, you can generally earn a higher risk of return. And so if we just move to the next slide, this kind of, this decision that you make between like, okay, I'm stepping out of cash, I'm gonna own a portfolio of stocks and bonds, the balance of stocks and bonds that you own, whether that's like 60-40, 80%, 20%, or 20-80, that is kind of like one of the most important decisions you'll make as an investor. And the reason is because that reflects, in a way, what your risk tolerance is, right? The more risk you're willing to take or capable of taking, the higher your allocation to stocks will likely be, and therefore the higher kind of volatility you're willing to endure in your portfolio, and vice versa. And the reason why that's so important is because what the studies and the research has shown, and this is kind of like the seminal study from '95 from Brinson, Hood, and Bivar, is that in the context of a well-diversified portfolio, 94% of your return variation, 94% of the risk and return experience that you will sort of achieve as an investor basically comes from that decision of like, how much stocks and how much bonds should I own, right? As much as we hear stories about picking good stocks and not picking good stocks and buying right at the low and selling right at the high or whatever, that really doesn't make a difference in the long run. It's really this asset allocation decision that kind of drives most of your experience. And so this is a personal decision, right? This is something that sort of you custom fit to your own risk and return objectives. But once you get it right, and once you get it appropriate for you, ETFs make it really easy to then build a portfolio out of that, right? So if we just move to the next slide, I think, right. And so say you're a 60-40 investor, 60% stocks, 40% bonds. From there, in a handful of trades, you can basically build a very complete, very well-diversified portfolio that you know exactly what's inside of it, and it's delivered at low cost using ETFs, right? And so for the stock sleeve, I think we just posted some things here to consider, right? What geographic mix do you want between Canada, US, international, etc.? Maybe you're mixing it up between large, mid, and small cap. Maybe you're layering on some strategies like some income-seeking strategies or some themes, specific sectors that you like. Again, the power of indexation has really just opened up this whole world to you, and you can sort of customize your exposure, find the right index, find the right ETF, and you can sort of build a portfolio from there. For bond ETFs, similar story, right? In a trade to a handful of trades, you can fill out that bond sleeve of your portfolio. Some things to look out for as you're doing that. What kind of bonds are you owning? Are they government bonds? Are they corporate bonds? What kind of credit quality are you grabbing? Sort of investment grade, which is kind of higher quality, or high yield, which is considered sort of less higher quality. And then the maturity. Is it short-term bonds, medium-term bonds, long-term bonds? But again, like the stock market, like the housing market, indexes have basically sliced the whole market into whatever flavor you want, and you can probably find the index in an ETF that will deliver it to you so that you can customize your portfolio to your own settings. And so really quickly, as I've just described, you can do that yourself. That's the left side of this graphic here, right? You probably in a couple to 10 ETFs, you can build your own portfolio very quickly and easily. There are actually a number of and this is actually one of the most popular end investor ETF segments we see in Canada. There are ETFs that do it all for you, actually. So all you have to do is make that one important decision around how much stocks, how much bonds. I want 60-40. There are ETFs out there that will basically, it's a 60-40 ETF. It will then compile a handful of ETFs for you that reflect a 60-40 portfolio. So in one trade and at low cost, extreme diversification, you're done. And then finally, option on the right, you can seek advice through a robo such as Questwealth, right? Who will sort of figure out for you what your risk profile is and what your risk tolerance is, presumably through a questionnaire or something like that. But I'm going to pass it to John to sort of describe that. And then we'll build you an ETF portfolio reflective of what I just described, your appropriate asset allocation, and a mix of ETFs that gives you diversification and low cost. John, maybe I'll pass that part to you.
Sure thing. We can touch on it a little bit more in the Q&A since I've got a special guest on for that one. But yeah, basically, with Questrade, we do offer two main ways to do it. Either do it yourself through self-directed investing, or you can have the pros do it for you through Questwealth managed investing. Main difference is self-directed. You're doing the research. You're picking which ETFs or stocks you want to buy. Whereas with Questwealth, just like you mentioned, you go through a questionnaire that determines how long you want to invest for, your risk tolerance, how you react to volatility when the market's roller coastering up and down. And then based on your answers, we then recommend one of our 10 different portfolios to you. So we can circle back to that a little bit. But yeah, let's finish off maybe here with the summary before we pass on to the Q&A.
Yeah, sure. Real quick. I mean, so just to summarize everything I said, I think ETFs, as the title of this course would say, diversified investing made easy, right? In as little as a trade, you can access literally thousands of securities reflective of your own risk profile. You can build portfolios in a modular way, in a very deliberate way, because you know exactly what's inside each of these ETFs, because the index rules are very transparent. And as we've touched on, and I think as this audience already appreciates very much, these are offered at very low cost, meaning you keep more of the return for yourself. And then really it comes down to sort of customizing for yourself what's right for you. Start with your risk tolerance, find your right asset allocation. From there, it's really easy, I hope, to slot in all the different ETFs that would fill your asset classes. But I also appreciate that with 1,400 ETFs listed in Canada, that can feel daunting. And there are options that will do it for you, right? So all-in-one ETFs will literally take that decision down to the asset allocation decision. And from there, you just have to buy one thing and you're done. Or you can talk to sort of Questwealth, and it's a similar idea, right? You figure out your risk tolerance and the right profile, and they'll do it for you.
Perfect. Thank you so much, Hale. We really appreciate kind of that quick summary on the benefits of ETFs. And I know I probably learned a couple of things during today's presentation as well. I know our audience definitely did too. And thank you to the over 1,100 attendees who tuned in. We still got a little bit to go for our live Q&A. So I'd love to introduce Adam from the Questrade studio, who's my co-host here, and Ben Kim, who's our head of Questwealth portfolio management, if he's available. And we'll quickly go through some of our Q&A questions. So maybe one that has come up a couple of times. It's on everyone's mind recently with all of the interest rate changes and maybe the differences between Canada and the US. And that's, how's the performance of a US ETF differ from the same ETF when it's hedged to Canadian? So I'm looking at, let's say, an S&P 500 ETF, and there's two versions of it. There's the strictly US dollar version, and then there's a Canadian dollar hedged version. What should maybe an investor consider when they're looking at the two options? Which one might be better suited for their portfolio? Just broadly.
Sure. So, do you want me to take that? I can take that
Sure,
one.
Hale, yeah.
Yeah, I think one thing to quickly recognize, as soon as you step outside of Canada in terms of your investment, you basically own two return streams, right? One is the underlying asset, so US stocks in this example, and then the second is the currency. And so if the US dollar appreciates, for example, when you translate that back into Canadian dollars, it will be a tailwind to your returns. But if the US dollar weakens, then it's going to be a headwind to your returns. And so, without giving advice, because I'm not permitted to on this platform, what I'd say is it really is going to depend on your view of currency direction, right? In general, if you think the US dollar is going to weaken, then you probably want to hedge that off. If you think it's going to strengthen, then you probably want to keep that exposure in your portfolio. In general, this is hopefully more of an academic point than one of advice. As a Canadian dollar investor, the Canadian dollar generally exhibits risk-on behavior. What I mean by that is when things are rallying, so does the Canadian dollar, and when things are selling off, so does the Canadian dollar. And so what we found is that against the US dollar, over the long run, it can actually be a buffering effect to keep the currency exposure on. In other words, there are diversification benefits to owning the currency exposure. But again, tactically, that might not always play out. And so it really depends on your view on the direction of currencies.
That's it. Ultimately, every investor is going to be a little different. And I guess it's your own intuition or your research that might help you to make that pick at the end of the day. It's just better to be informed. Look at the history, look at what the Canadian dollar's done, look at what the US dollar's done, and you can make your best educated decision kind of from there. Maybe a question here for Ben. Thank you again for joining us today. And this question came up from a couple of people in the audience on if somebody's concerned about certain ETFs being exposed to things they don't want to invest in, let's say like weapons manufacturing, wars, things that are undesirable. Is that something that Questwealth covers in different kinds of portfolios? Are there different portfolios available to us that maybe don't want to invest in these companies, don't want to invest in these less desirable sectors?
Sure. Thanks for having me. So yes, we do offer something called socially responsible investing portfolios, SRI portfolios. So what we do is we look at the ESG scores and also the different socially responsible index numbers. And then we look at also the ETF that are available out there. And then we basically handpick the ETF that would meet the criteria that we preset to construct a portfolio that would have, it's not going to be 100% no weapons or no tobaccos, but it's going to minimize that exposure for you. Therefore, you can invest while keeping your values and what investing for what actually matters for the next generations.
Definitely. Thank you so much, Ben. And if anyone's ever curious on what each portfolio holds, if you go to questrade.com under Questwealth portfolios, you can see exactly which ETFs are in, let's say, our conservative SRI portfolio versus the aggressive non-SRI portfolio. So full transparency. Yeah, and that way you can kind of be a better informed investor even before you put your money to work.
Absolutely, yeah. So let me just quickly add on, like, because there are so many ETFs available in Canada and US. In Canada, there are over 1,000, and in United States, there are over 2,000. So it is difficult to pick, and that's where we come in. We do all the hard working for you, whether it's the currency market, and then we handpick the ETFs that we feel that is best for our customers, and we construct that portfolio for you.
Perfect. Thank you so much, Ben. Got one question here, maybe before I hand over to Adam for if you've spotted any really good ones. And this one can be either for Hale or Ben, or even both of you guys. We welcome the opinions. And this talks about the MERs, or the management fees of ETFs. We talked a lot about how ETFs are cheaper than mutual funds. Mutual funds talking 2% sometimes, whereas an ETF, you're looking at maybe 0.2%. How is that charged to the investor? Is that like a bill I get at the end of the year that's deducted from my cash? Is that deducted from the total return? So instead of a 10% return, I get 9.8. Can you guys elaborate a little bit about how MERs are actually charged within ETFs?
Sure, I can start. Ben, feel free to jump in if I missed anything. But basically, an ETF, like a mutual fund, has something called a NAV, a net asset value, and that is the assets minus the liabilities of the fund. That's basically the value of the portfolio. The assets themselves is the portfolio, which is basically the dominant piece of the balance sheet. And then every day, on the liability side of the NAV are smaller things, but one of those things is like an accrual for the fee. So every single day, a very tiny, like take the MER and divide it by 365 every day when they calculate the NAV, which is calculated daily. They mark the asset side of the book as closing market prices of all the securities in the fund, and then they charge a little bit of management fee every single day. And so basically, as an investor, for whatever length of time you hold the thing, you experience exactly your proportionate share of that MER.
Yeah, so exactly. So this MERs are not something that you're going to see. You're not going to get a statement saying that this is how much MER you paid. It's a daily fee that gets baked into the pricing of the ETF itself. And therefore, it's already all paid when you purchased it. Like, it gets charged daily and you'll never actually see it.
Perfect. Thank you so much, Ben and Hale. And maybe to add on to that, one interesting comparison when you're comparing two different ETFs with very different management fees. Let's say they both track the TSX 60, and one has a management fee of 0.5, one has a management fee of 0.2. You can actually see that in the long-term performance of the funds and how closely they track the index. The one with the higher fees isn't going to be able to track the index as closely because every single day they're having to pay a larger chunk back to that MER. So another big argument for low fees there. Adam, do you see any good questions from the audience here that you maybe want to serve up to anyone?
Yeah, so there's a lot of good questions. And one is, I think that you guys can also touch on, is that if you own shares of an index, an ETF, do you own shares of the companies that make up that ETF? So when you own shares of that ETF, essentially you're indirectly owning the shares of the companies, but you don't own the actual stocks and you don't have things like voting rights, but your investment still is tracking the performance of that overall ETF. So you don't own those companies, you own the ETF, but essentially you do have a percentage, an interest in the appreciation of those companies. So it's a little bit different than owning it straight up, the company.
Perfect. And to maybe make things more confusing, you'll see a lot of ETFs that have another ETF inside of it. This is very popular with all-in-one products that maybe have a bond component and then an equity component that are baked right in. So whenever you're doing your research, not advice, but I always like to see what's inside of the ETFs and kind of go down the rabbit hole sometimes. And that's an easy way to compare to make sure you're not accidentally investing in the same thing. So if you are considering different ETFs, kind of limiting that overlap is one of the things that you should be taking a look at there. A couple more questions because we are at time here, and I don't want to keep anyone too late past 1 o'clock in case anyone's got back-to-backs meetings. So maybe we'll finish off with 1 or 2 more questions. Maybe a quick one for Ben and then a quick one for Hale. Ben, what is the cost of Questwealth services? So what is the overall kind of fee someone would pay to have their money managed by Questwealth?
Sure. So on top of the MERs that is baked into the pricing of the ETFs, we charge something called management fee. This is the fee that you pay to us for the management of your portfolio. So we start at 0.25% annual. And if you have over $100,000, we go down to 0.2%. So on a $1,000 investment account on a year, you'll be paying $2.50. And this includes all the trading commissions, all the currencies, everything that we do, all the services. So it is all inclusive and all in one fee.
That's fantastic. Thank you so much. And that's maybe something to consider for a lot of us self-directed investors, kind of comparing the costs of which one would be better for you long term.
There was also another question, which kind of you just answered, but essentially somebody was mentioning that they're looking for one ETF that has a 60-40 ratio. And so it sounds from the sound of that question, it sounds like you're looking to have a portfolio that is managed for you essentially. So something like Questwealth portfolios is something that you should be maybe considering if you're looking for something where you can take your hands off of it and trust that, people who know a little bit more have the time are allocating that time to your portfolio. One other good question I saw, John, was that someone mentioned that, there is the new Bitcoin ETF, but they're wondering essentially what is considered a diversified investment. They're kind of wondering if having that one ETF is diversifying your portfolio, but the question was, what is considered a diversified investment? Maybe, Hale, if you could maybe just explain what qualifies diversification.
Yeah, I think you should consider diversification across a number of dimensions. So, at the highest level, it's your allocation between stocks and bonds. That in and of itself is diversification, right? But then within equities, regional diversification, kind of not just Canada, but owning kind of global exposures, that's diversification. Diversification across sectors, that's another form of diversification, right? In Canada, we are very focused on banks and energy. As soon as you leave Canada, you start getting more tech, healthcare, et cetera. And so that type of diversification to different business lines that you're invested in helps. Single security diversification, also important, as we already kind of touched on in many versions in the slide deck. But as you kind of build out, you sort of buffer yourself against sort of concentration in any given stock, industry, country, et cetera, or asset class, right? And then within fixed income, it's kind of a similar dynamic, but with different metrics, right? Like regional things apply, right? Geography, but also credit, how much sort of low credit quality versus high credit quality stuff, how much government versus corporate, like all of these are levers of diversification that you want to consider in your portfolio. To answer your question about like, can you get it done in one ticket? You certainly can, because the 60-40 asset allocation ETF, for example, will give you something like 18,000 securities as the underlying, split across asset classes, split around geographies, split across sectors, and split across kind of fixed income characteristics. So yes, you actually can achieve it in one trade.
Thank you so much, Hale. And thank you again, everyone. As the old saying goes, don't put all your eggs in one basket. So same applies for ETFs too. Make sure you kind of look under the hood before making any decisions and really do your research. And thank you again, everybody. Thank you, Hale. Thank you, Ben, for your time today. And we're looking forward to the next one.